So just as a pointer as to where we're likely to go when trade gets underway in less than half an hour now, we saw a very positive session overseas, particularly in the States, with the key indices there moving above 2%. And of course, yesterday we saw a positive session here, and SPI futures currently up 0.75%, indicating we will get another day of positive trade here. Well, let's get to it and what to watch out for at the moment. James Gerrish joining us from Shaw and Partners and author of Market Matters. James, a very good morning to you. All right, so that was the classic bear market rally we saw overnight, was it not?
Time will tell, Andrew. So obviously it depends probably on time frame. So I think when markets get oversold like they do, or like they have been, these sort of rallies is understandable. I think it depends on what economic outcome we have. So obviously inflation's the main driver of concern in the market at the moment. If we see some signs that inflation is starting to cool a little bit, or rate hikes are having an impact there, then the market could well rally from here. So I'm in two minds at the moment, to be honest. But I think probably in the short term, we've got a little bit more upside to go.
All right. What are you looking at the moment, of course, over the past week or so? Financials, the banks sold off quite dramatically. Are you seeing value there now?
Yeah, so I mean, the banks are interesting. Obviously, they've been whacked in the last little while. We actually had this is the MD from Bank of Queensland in yesterday talking about their how their book is looking, their outlook on rates, and also importantly credit quality. So they were talking that they had the average borrower is 15 months ahead of their repayments. They've got they've got less than 1% of their book with an LVR greater than 90%. So it comes down to, I think, banks, the credit quality of banks, I think, is in pretty good shape leading into this, these current economic woes. So I think banks are probably deep value, or looking to be value at these current levels. I mean, they've fallen pretty substantially over a very short amount of time on this expectation that we're heading into a recession. I'd probably suggest that they're pricing a high degree of recession when there's probably a 50-50 chance of a recession at this stage.
Any particular ones you like?
Yeah, so I mean, we actually own Bank of Queensland. We own CBA, sort of that barbell approach. So you've got the best in the sector, and you've also got the one that is more of a self-help story. So by that I mean, they've got a big technology push over the next couple of years, which is going to reduce their cost to income ratio pretty substantially. So they've got something that they are sort of working to improve their business over the next couple of years. They're cheap at the moment because of the metrics. Are weaker than the big four, but that will improve. CBA, I mean, has just got the best metrics. They've got the best technology platform, and they can drive that top line growth more than other banks can at this stage. So CBA is our other pick in the space.
James, another sector that has seen significant selling just recently is in the resources space. Some of the big miners hit hard, obviously with the iron ore price continuing to move lower. Gold miners also coming off as well. You still got us, James? Yep.
Yeah, certainly do, yeah.
Yep. So what are you thinking then about resources and where that's going?
Yeah, you rightly point out the weakness in the iron ore space. Obviously, we've got some sporadic Chinese lockdowns, but you've also got a seasonally high period of supply in China. It's a seasonally high period of supply, iron ore supply, at a time when inventories are high. So steel inventories in China are at elevated levels. So that's obviously going to lead to some softness in the iron ore price, which we've seen. I still think in the short term I'd be more cautious on the pure plays. Fortescue, Rio is pretty much a pure iron ore play. I'd be keen more towards BHP. So obviously energy and oil has been in focus. I know that's come off the boil with crude down around 110 a barrel, down sort of $15 from the highs, but we still think that's got a better longer term driver or medium-term driver. I think speaking long-term in this market's a pretty optimistic thing to do. So, in the commodity space, I think BHP in the diversified space is probably the one to go to.
Yep.
We like our Independence Group in the sort of these in the battery metals space, and we've written a note this morning on Pilbara in the Market Matters report, and our positive preference for that as well.
Yeah. And just quickly, how do you look at the gold miners at the moment? I know your colleague Peter O'Connor certainly say is the cheapest part of that sector at the moment. Continues to promise, but doesn't deliver at this point.
Yeah, Rocky's been bullish on gold for a little while now. Obviously, and I agree with him at this point in time. So they are, they're cheap. They're trading a long way below NTA. They've got you think about the drivers of the gold price. Everyone hangs their hat on inflation being a driver of the gold price, which I think is true. But this has been, in recent times, it's been offset by the strength in the US dollar. So the fact that the US dollar has been strong because they're expected to raise interest rates at a quicker, more aggressive pace than other areas of the globe, that supported the US dollar. Also, there's been a level of risk aversion. So if markets settle and expectations around rates over in the US ease, and you can make the case for a lower US dollar, and that'll feed into a higher gold price. So, and you've sort of got to be positioned ahead of that time. So I agree with Peter. I think gold stocks are cheap at this level. They need a catalyst. The catalyst would be a pullback in the US dollar, and then I would think we'd see gold equities follow the underlying commodity higher.